I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers podcast show. It is Wednesday, June 8th, and this is another interest rate update for today. We do this Monday through Friday. And if you are new to the channel, be sure to subscribe, like, and comment. And remember, this is for informational purposes only. Why, Tom?
That's right, folks. We're smart, but we're not that smart.
Exactly. Right into today's interest rates. We see the 30-year fix at 4.99%, the 15-year fix at 4.25%.
Boy, today's almost a mirror of yesterday. 5-year ARM, 4.625. The 30-year FHA, 4.375. And the 30-year VA, 4.375. Exactly like yesterday.
Yeah, that's right. And these interest rates, we're quoting these rates based off of this information right down here for conventional FHA and VA loans. There are no discount points. You're not paying any buy down points or extra fees to get these rates today, and a lot of other banks are.
Yeah. And in a market right now when rates are a little higher than they used to be, they are trying to show you lower rates. And the only way they can do that is by charging you extra. That's what we call points.
Yeah, it is not normal to be looking at, if you see a rate at 4.99% from another lender and you see $3,000, $4,000, $5,000 in extra cost, that's going to be very common. That should not be something that you should be seeing, though. You don't want, that is a lender who's charging you too much. And let's just go right into today's topic. Again, we've shown this before. We're going to continue to follow this, the story of the recessions. Of course, are we in a recession now? That's to be determined because the second quarter GDP is coming out. Well, at the end of June will be the end of our second quarter. And then it'll be in August when the government will tell us whether or not the GDP number was negative or not.
Yeah, so you're always looking backwards.
Always looking backwards.
It's not like they actually see it coming, even though people kind of see things coming. Yeah. But it's not until you've already passed it that you actually know.
So in August, we'll actually know if we are currently in a recession now. And the big question people are thinking is, are we in a bubble right now? Are house prices going to decrease? Oh, gosh, let's sell now. Do you sell your house now or not? Is now a good time? Mm-hmm. And we wanted to show you in the last 48 years, this is from the St. Louis Fed. It's one of the biggest organizations. It's basically an agency that takes the data, a government agency that takes this data from all over the country. And this is on a national level. You will see the last 7 recessions are here highlighted in these gray columns. And Tom, the only time home prices really decreased was that 2008 recession.
Which is amazing. I mean, this chart is so insightful. And the reason why we had that recession back then was frankly caused by the H word, the house word, the homes.
The homes.
I mean,
that's right.
Look at that. But if you go back to the other ones, how many recessions we said here? 7.
Yeah, 7.
And there's no significant drop.
Yeah, you could say that in 1982, maybe it was very flat. Mm-hmm. In the 90s. And of course, every region is a little bit different. So like if we look at our city, we concentrate here in Phoenix, basically.
Right. Look at this chart.
The Phoenix market is all of Maricopa County. And this is from 1977. And this is showing the 6 recessions, but doesn't go back as far. Mm-hmm. And only, again, if what you'll see is a little bit different line here. You'll see how the run up here in 2008 or 2005 and 6, and then down here and here's the recession. But yeah, I was
going to say Phoenix has always been a more exciting market than most.
Yeah.
We've seen some better times than most, and then we've seen some worse times than most. That's kind of the way that we are built with our economy. But yeah, so this chart here does show something different than what we showed on the national level, which is very insightful.
Yeah, and I'm going to show you these slides. Just look at the slides right now. I'm going to flip over. Here's the national. Here's the Phoenix market. Mm-hmm. I'm going to do that again. Here's the national, and here's the Phoenix market. And I think it's really important because people are asking, is this the same? Or is this the same setup? Are we going to repeat 2008? Well, here's what's happened. Here's the differences, really. And if you're new to the channel, be sure to subscribe because we are covering this over and over. We're going to keep, as things change and
as they develop, we're going to be
watching
in touch on this.
And in 2008, the setup for this, we had very high. There was a lot of inventory on the market. There were a lot of homes for sale. Okay. Underwriting guidelines were horrible. I mean, anybody who really wanted to get a home could purchase a house. You didn't need to verify your income or assets. There were a lot of rental homes on the market.
Yeah, and if you look past or prior to that, I don't know, 5-10 years, there were a lot of homes being built.
Yeah.
There were a lot of homes being built, which basically created all this inventory that XYZ people owned. A lot of those were investors. And we're going to hit that slide where we're going to show where those vacancies are. Vacancies are an important part of how you look at a market because
let's go right to that.
Yeah.
So in 2000, back in 2008, we saw like the vacant homes for sale. Okay, and then we're going to show vacancies here soon. But there were 2 million vacant homes for sale.
2 million, and you don't even know that. You drive through neighborhoods, you can't see a vacant home.
Yeah,
I mean, if you're a neighbor, you can. But if you were to fly over an airplane, I mean, 2 million homes vacant. What a big deal. Now compare that to today.
Yeah, so there's just about a little over 667,000 homes for sale. This is, it's only 33% of what it was available in 2008. And everybody knows that it's hard to find a house. And yes, maybe there are a couple homes coming on the market nowadays. Now.
Yeah, a few more listings.
A few more listings. But let's look at this. Lots of rental vacancies back in 2000 for that 2008 recession. A lot of rental vacancies. It's hard to find a rental now, and rental properties are really expensive.
Right. Yeah, the rental properties have to keep up with what the mortgage payments are.
That's right. So, in addition to this, I'm going to go back to this chart right here. Is that in 2008, right about here, the average mortgage that people had on their home was about 6.3% for a 30-year fix. That was their average. Today, the average, if you were to ask the average person, hey, what interest rate do you have? They're going to tell you like 3% or 2.5%, something ridiculously low. They're very comfortable with their payments right now. Back then, they weren't. People had a motivation to sell, so that the inventory was high on the market. There were a lot of inventory on the market. People were motivated to sell their home. Today, people are nice and snug in their home and comfortable.
Yeah. Yeah, and we also have that P word, the pandemic word, where we're still coming off of the wake. We're still coming off of some of the issues with that. We have the supply chain issues. So there are things unique today that we haven't seen in the past 50 years.
Right.
So how do you analyze that again? And that's the whole we're not brain surgeon part to this podcast. We're simply delivering information, and it needs to be interpreted the correct way.
Yeah. And now we have home builders who are getting into the market of rental properties. Lots of rental properties on the market. More and more.
We never had that dynamic.
Yeah. So this is different. Different than 2008. We have home builders. We have small LLCs, big LLCs, BlackRocks buying homes and renting them out. So again, inventory. There's not going to be. I don't see a lot of inventory coming on the market. I don't see where we're going to get a lot of inventory. So I do think that the thesis is starting to develop. This is not going to repeat 2018 or 2008. Things will likely, in my opinion, be like they were for the other the 5 other recessions.
And I've never actually liked this term, but the new normal. I mean, because it just sounds so good. But I never really thought that really applied a lot. But I do think in today's world, we might be there. We just have a new set of circumstances that have never been, we've never had before. And will probably not be duplicated anytime soon.
So we'll keep posted we'll watch the developments. We'll keep it posted. Be sure to subscribe, comment, and like everybody. And we'll be back tomorrow.
All right. Thanks, folks.
Thank you, everyone, for watching our show today. If you have questions, be sure to email us at rates@azmortgagebrothers.com, and be sure to take a look at all of our other videos on our channel.